About a year ago, you'd been hard-pressed to find an investor that was more excited about Unity software than myself. But those opinions changed rather quickly when this company stumbled. But if we look at how Unity has done so far this year, it's up 54%. And with the company having just reported earnings yesterday, could I have been wrong about Unity? Let's spend the next 10 minutes finding that out. My name is Brian Stoffel. Not surprisingly, I do not own shares of Unity as of the time of this recording, and I want to give a shout out to YCharts for sponsoring today's video. More from them in just a minute. So let's look at Unity's second quarter of 2023. It's about a $16 billion company. On the top line, revenue grew 79, yes, you read that right, 79%. That comes with a caveat, but that beat Wall Street and management's guidance. On the bottom line, the company swung to a non-GAAP profit of 23 cents per share. That also beat management's estimates. However, real growth was only about 11%. That's because the company's acquisition of ironSource, which we'll talk about in a minute, last year is what really juiced those results. If we look at margins, it was a pretty good story in terms of direction. Gross margin expanded significantly to 70% on a GAAP basis. Now, operating and net margins improved markedly. However, if you look at where these stand, it's still nothing to write home about. These are still decidedly negative right now. On the other hand, free cash flow did swing from a loss of $60 million to a gain of $34 million. Net income is still largely negative, and the balance sheet is upside down on Unity right now. Now, the company did say that they were cash flow positive, and they believe they can be sustainably on the positive side of cash generation moving forward. If that's true, that is a very significant and important development. Let's just go down right here, the income statement, to see how we got to where we are. Like I said, about 80% growth in revenue. The cost of that revenue only grew 64%. When the cost of revenue grows slower than revenue, that's great because it means gross profit grows even faster, which was the case here, up 87%. If we look at operating expenses, those were only up 42%. We can see really significant increases in sales and marketing right here, but 42% is still slower than that top line growth of 80%. Now, it is worth noting that those operating expenses alone of $566 million are more than all the revenue the company brought in the quarter. So while it's headed in the right direction on an absolute basis, it's still pretty ugly. Because of that general direction being positive, the loss from operations narrowed by 3%, net loss narrowed by 5%, but wait for it, the number of diluted shares outstanding increased 28% from the same time last year. Again, a big part of this is the ironSource merger and the taking on of debt. It is senior convertible debt, which is assumed to convert into shares. It's also worth noting that there are significant depreciation and amortization expenses, and stock-based compensation continues to be quite large, accounting for 30% of revenue during the quarter. These two things alone pretty much explain how a company with a net loss of $193 million can actually generate $48 million in terms of operating activities. Now, usually I am one who is just fine with stock-based compensation. However, the company needs to be executing to do that. And if we look over the last 3 years, I don't think that's the case with Unity software. Now, diving into the two parts of the company, Create Solutions was up 17% year over year. This is just the flat rate subscription to use Unity software to create metaverse experiences. They said that it was driven by core subscriptions that was up 22%, excluding China. This is the kind of play on words that drove me crazy as a shareholder, where they're always withholding some piece of information that could help give us a better idea of what's going on, excluding China. Well, tell me what it is including China as well. They don't do that. Now, on the other hand, the gaming community has been the largest customer for Unity's tools. However, industries outside of games now account for 30% of that subscription revenue in Create Solutions. That is important. That is something that gives the company optionality and really could be a driver of future growth. Also want to point out that the number of artists that are using the platform that aren't gamers is really driving, management said, new consumption. Digital twins is a big part of it. And then CEO John Riccitiello says, I hope you listen carefully. We'll get to why I'm being a little sarcastic here. We're getting great traction in the market, and we're now focused on delivering repeatable solutions, high margin, deliver ratable revenue streams, and consumption revenue streams. That's all fine and good. On the growth solution side, this is where people who make games are able to monetize them. Revenue is up 157%, but almost all of that came from ironSource. It was just up 7% on a pro forma basis. So not as exciting, nothing to write home about there. This is important as well. The number of $100,000 customers that the company had did tick up sequentially. However, since the company went through the ironSource merger, it is still down from where it was 2 quarters ago. That's not great. The dollar-based net expansion rate also contracted to 106%. That's not great either. So let's turn to guidance. Management is pretty much calling for 69% growth. That obviously includes ironSource. The only important thing is that's slightly less than Wall Street was expecting. Though Wall Street doesn't seem to mind because shares are trading up today. Management upped their guidance for the full year. However, it also still at the midpoint comes in below Wall Street's estimates. So let's take a timeout here and let's go through why I'm being a little bit sarcastic. Look, Unity had a solution where it was subscription on one side, usage based on the other, really encouraging. At the beginning of the last year, the company announced that they ran into some troubles. There was trouble digesting data, and because of that, they weren't getting kind of revenue from their grow, at the time it was called operate, from their grow solutions. Management said, we've got a fix for it, no big deal. Well, the fact of the matter is, what seems like happened is they thought they had a workaround for Apple's ID changes. This is the story in my head. And then they didn't. And they didn't create a solution either. Instead of doing that, they went out and bought ironSource. And by doing so, saddled the company with tons of debt that could be converted into shares, which will dilute shareholders probably about 30%. So no, this is not something that I'm excited about. It's also very, very difficult to trust a management team that has just done this. With that being said, let's look at the company's what we're going to look for moving forward if you own shares. First, that dollar-based net retention. It's got to tick up from 106%. I know the ad market for games is soft, but it's got to tick up. Number 2, the number of $100,000 customers. Number 3, free cash flow. Number 4, normalized growth. So not including that ironSource until we've lapped a full year. And I'd actually throw in a 5th one here and just say commentaries about industries outside of gaming that are using this platform. Look, I don't think that I can assess how strong the moat is anymore, so I'm not going to give a moat or a thesis verdict on this. I just don't think I know enough to be able to do that. What about valuation? Well, it's hard to say where this company is. Somewhere between phase 3 and phase 4, which means we can look at things like price to gross profit, maybe forward priced earnings or price to free cash flow. And for that, we go to YCharts, a tool that Brian Feroldi and I use every day. If you click on the link in the show notes below, you can have a free trial at YCharts and mention Brian Feroldi's name, and you'll get 20% off your subscription. So if we look at gross profit, Unity had generated about $1.06 billion in gross profit before yesterday's earnings, about $1.24 billion now. That gives it a price to gross profit of 13, which is pretty expensive. If we look at price to free cash flow, well, that's over 1,000. The company is not optimized for free cash flow, so this is largely useless. And then if we look at the forward P ratio of 92, that is quite pricey. Again, the company is not optimized for it, which leads us to ask, well, what can we use to be able to make this decision? And we could look at its price to earnings power. For that, what we do is we go over here, we type in the ticker symbol, we get Unity, we put the revenue over the last 12 months, and after earnings, we see that it's about $1.8 billion. And then we say, well, what could its profit margin be? You could say, all right, well, it could be 15%. That puts it in the realm of some SaaS companies. If that was the case, it'd be trading today for a PE of about 58. If you up that to 20, it's still trading for about 44 times earnings. If If you get really, really optimistic and say they could have a 25% margin, it's about 35. But look, this is based on optimized earnings growth with a management team that I don't particularly trust, being able to do that while shares are being diluted so heavily. That is a high bar to cross. And so because of that, I would say that it's not a very attractive valuation today. And valuation, when you're talking about these companies that barely have anything to go on, can be very difficult. And that's why Brian Feroldi and I are excited to announce that our course, Valuation Explained Simply, is open right now. It will start on August 7th, and we'll cover a number of different ways to measure valuation. It'll be every Monday and Wednesday from 8 to 9:30 p.m. Eastern Time. If you're interested, you can click on the show notes below and put in the code. It's last call 149, not 49. Last call 149. And you'll get our biggest discount that is available. Look, all things told, Unity is no doubt positioned to benefit from the metaverse. There's no doubt about that. But I simply, at this point, don't believe the combination of this management team, inability for me to measure the moat, and this valuation makes it so that I don't want anything to do with it right now. If they got a new management team in there, it was something that I would consider, but I understand that others might have a different opinion. If you do, put it in the show notes below. We'll check back in on this one in 90 days. Until then, Brian, out.